All right, so let's dive into this whole stock market thing, especially, the companies that are all about us consumers and our spending habits.
Yeah.
It's pretty interesting because while everyone's busy freaking out over tech stocks, the consumer discretionary sector is kind of just like chilling out in the background, quietly getting stronger.
Yeah.
We're talking about those treat yourself purchases, and we really dug into some recent analyses to bring you the juiciest insights.
It's really interesting.
What's that?
There's this whole underlying current that's kind of pushing things along, and that's the Fed cutting interest rates.
Because when interest rates go down, people tend to loosen their grip on their wallets a little, right? Like it's a little easier to justify that splurge. Lower interest rates make it cheaper to borrow money, which encourages, spending, and that really gets the whole economic engine going. Here's the thing, what's even more interesting is that, like, even if the Fed decides, okay, we need to slow down a bit on these rate cuts to keep inflation in check, it still kind of tells us that the economy's doing all right.
Right.
And a strong economy usually means people are feeling a little more, shall we say, spendy.
That makes a ton of sense, especially when you consider the stat we found from T.S. Lombard. Apparently, the U.S. consumer debt service ratio is practically back to where it was before the pandemic hit.
Wow.
So that basically means that people are getting a much better handle on their debt, which, logically would make them feel a bit more comfortable spending on things they want, but don't necessarily need. It's like a weight off their shoulders.
Yeah.
If they're not as stressed about debt, they're more likely to say, you know what, I'm going to go for it. I'm going to get that new TV or book that weekend getaway.
Yeah.
And that is great news for all of those companies in the consumer discretionary sector.
It's like a chain reaction of good vibes for the economy.
Exactly.
This actually connects really well with what Chris Senyek, he's from Wolf Research, is predicting about the housing market. He's saying that we're probably going to see a bit of an upswing in home sales.
Oh, interesting.
And I feel like we can both kind of put two and two together on that one.
Yeah, I mean, when people buy new homes, what do they usually need? New furniture, new appliances, new decor. That all falls right into that consumer discretionary category.
It's like a domino effect. Speaking of things going up, the Invesco S&P 500 equal weight consumer discretionary ETF that recently broke above $53. That's got to mean something, right?
Oh, it definitely means something. Investors, they use this ETF as a way to, gauge the health and potential of that entire consumer discretionary sector.
So it's like a report card.
Kind of, yeah.
Yeah.
And breaking above $53, that's like getting an A on the test. It shows a real vote of confidence in those companies.
So to sum it all up, it sounds like all signs are pointing towards a potential spending spree.
It's definitely looking that way.
But, before we all go out and max out our credit cards, we got to remember not everything that glitters is gold. How do we, as savvy investors, as people who really want to make smart decisions with our money, figure out which companies are truly ready for that kind of growth and which ones are all hype?
Yeah, it's like, how do we separate the wheat from the chaff,
Right. It's tough.
Luckily, though, the fine folks, they did some digging for us, and they actually identified some pretty interesting companies within this sector
Yeah.
that are, looking like they're more than just a flash in the pan.
And what's really cool about their picks is that, it's not just about hype. It's not like, oh, this company's stock is up this week, so they must be great. These companies, they've actually got a really solid track record.
Okay, I like the sound of that. Yeah, we're talking companies with, they've had some recent stock rallies, but they also have this history of consistently beating Wall Street's expectations.
Okay, so they're overachievers in all the right ways.
Exactly.
So give me the inside scoop. Who are these market darlings? Who should we be keeping our eyes on?
All right, so let's start with a couple of familiar faces, especially if you've ever set foot in a home improvement store.
Okay.
We're talking about Lowe's and Home Depot.
Oh, yeah, those are classic.
All of them have been on a tear recently, hitting record highs. And like we were talking about before, they consistently just blow past those earnings forecasts.
Interesting. So does that tell us that maybe the housing market is actually doing better than some people might think?
It's a really good question, and it's something to keep an eye on, for sure.
For sure.
Now, switching gears a little bit, let's jump over to the travel industry, because Booking Holdings, another company that just hit a new stock high last week, and they've got this knack for, they always seem to deliver these positive earnings surprises.
So maybe people are like, you know what, inflation, schmation, I'm taking that vacation.
It seems that way. People are ready to get out there and travel.
I love it.
Okay, now for a company that I think is near and dear to a lot of people's stomachs,
Okay, now you're speaking my language.
we got to talk about Darden Restaurants.
Oh, yes. The Olive Garden, the Longhorn Steakhouse, all those classics.
All the comfort food, all those breadsticks.
I'm getting hungry just thinking about it.
Right. Their stock is up 16%, and it's actually getting really close to its previous high. Analysts are projecting, I think, something like 4.9% annual sales growth through 2027.
Okay, so steady growth. But something tells me that Darden restaurants with those endless breadsticks, I feel like there's potential for even more.
That's the exciting part. So Darden's got these big plans to open hundreds of new restaurants in the next few years.
Oh, wow. So they're really expanding.
They're expanding, which means new markets, new diners. And then on top of that, inflation is still a thing. Menu prices are going up.
Yeah.
And that obviously boosts their sales figures.
Right, of course.
And if that debt-to-income ratio that we were talking about earlier is any indication, it seems like people might be like, you know what, I'm a little bit tired of cooking at home. Let's go out to eat.
Yeah, it's a treat. Why not?
Exactly. But here's the thing. Strong sales don't always mean a company's making a ton of profit. So what is it that Darden's doing right? What's that secret sauce?
Right, because at the end of the day, that's what we care about as investors, right?
Absolutely. So one key factor is that they've got a really, really good handle on their fixed costs.
Yeah.
So you can think about it like this. If your rent stays the same every month, but you suddenly start making more money, you get to keep more of that extra cash.
Right.
Darden's doing something really similar.
Okay.
So as their revenue keeps going up, their profits are getting this nice little boost.
Makes sense.
Exactly. And then on top of that, they've been strategically buying back their own shares.
Okay, and explain that one to me, because that always sounds a little counterintuitive.
So it seems weird, right? But it actually ends up increasing the earnings per share for the investors who are still in the game.
So it's like they're cutting themselves a smaller slice of a bigger pie, so each slice is worth more.
Exactly. You got it.
Okay.
And speaking of earnings, analysts are predicting that Darden's earnings will grow by something like 11% per year, hitting $12.40 per share by 2027.
Those are some delicious numbers, but, I mean, based on Darden's history, it sounds like they might even be capable of more than that, right?
That's the really exciting thing, is that they've got this history of kind of blowing those expectations out of the water.
Right. But before we get too carried away with those cheddar biscuits, those endless breadsticks, let's shift gears a little bit here.
No.
Because we've been talking a lot about this treat yourself kind of spending.
Yeah.
But what about a company that's all about value? We got to talk about Walmart.
Ah, good old Walmart.
I mean, they're not exactly the first name that pops into your head when you think, like stock market superstar, you know?
It's true. They don't have that, like, flashy tech company vibe.
Right. But it's wild because while everyone's out there chasing the next Tesla, Walmart's just been quietly, like, racking up some seriously impressive gains.
Yeah. They're like the tortoise and the hare story, you know?
Totally. Except Walmart's not exactly slow.
No, they're not.
I mean, we're talking 50% growth in the past year alone. That's pretty incredible, especially for a company that's already, massive.
It really makes you think about, like, the whole long-term game, you know? Even a company like NVIDIA, which, let's be real, their stock has been, like, skyrocketing over 150% this year. Even they can't keep up that pace forever.
Right. Like, at some point, there's got to be a ceiling.
Exactly.
And it kind of reminds me of something that Bespoke Investment Group pointed out. If NVIDIA kept growing at that rate, they'd basically, like, own the entire global market, which obviously isn't going to happen.
Yeah, the math just doesn't work out.
Doesn't add up. But, it really highlights that sometimes slow and steady really does win the race.
For sure.
Yeah.
And let's not forget, there was a time when people were, like, really doubting Walmart. They're like, oh, is online shopping and everything Walmart? They're done for. Like, remember when everyone thought those physical stores were going to be a thing of the past?
Oh, I totally remember that. Like, the death of retail, everyone was saying.
Right. But Walmart has proven those doubters so wrong.
Totally.
I mean, they haven't just survived. They are thriving in this whole new retail world.
Thriving. And, like, they're straight up outperforming some major players. I mean, we're talking Alphabet, Apple, even Amazon.
Even Amazon.
I know. And get this, they're even doing better than Tesla, stock-wise.
They're killing it. So how are they doing it? What's the secret sauce?
Right. Like, spill the tea. Walmart.
Well, there's this Baird analyst, Peter Benedict, and he calls Walmart an omnichannel retail disruptor, which basically means they've figured out how to blend online and in-store shopping seamlessly.
So they're not just like attracting those budget conscious shoppers, which makes sense, especially with inflation and everything. But they're also winning over those people who, have a little bit more to spend. I
Exactly.
mean, their online marketplace, those more, I guess you could say like upscale brands they've introduced.
Yeah, they're covering all their bases.
That's pretty smart.
It's a really smart strategy. But here's the thing. Retail, it's just one part of their whole game plan. What I find really fascinating is how they're diversifying their income streams.
Right. Those alternative revenue streams like advertising and the Walmart membership.
Exactly. And those are absolutely booming right now.
I can see why.
Right. And the cool thing is those streams tend to have higher profit margins than traditional retail. So they're set to really boost Walmart's earnings growth in the near future.
So they're basically like playing 3D chess over there at Walmart headquarters.
They're thinking ahead, that's for sure.
That's good. That's reassuring, I think, for investors, especially those who, you know, might be a little hesitant about Walmart's stock price right now because, let's be real, it is trading pretty high.
That's true.
But, I mean, based on what you're saying, it kind of sounds like they're doing everything right.
Yeah. And Benedict, the analyst we were talking about, he actually argues that, like, their growing market share, those profit margins that are just getting bigger, the potential for shareholder returns, he thinks all of that justifies the current price.
It sounds like they're firing on all cylinders. But, speaking of hitting the mark, sometimes even a stellar performance isn't enough to please those fickle stock market gods, right?
Oh, tell me about it. The market can be so unpredictable.
Case in point, Carnival Cruise Lines. So, on the surface, their latest earnings report looked like smooth sailing. They beat expectations, record sales, strong bookings, all the way through 2025. Like, what more could you ask for?
Sounds like a dream, right?
Right. But then they released their outlook for the next quarter, and it was just a smidge, like a tiny bit lower than what those analysts were hoping for.
Uh-oh.
And the market just, like, threw a temper tantrum.
Pretty much. Even though their current performance was amazing, that slightly less rosy outlook, it just spooked some investors, and bam, their stock price takes a dip.
It's wild how sensitive the market can be. Even with, like, objectively good news, those broader market trends, that whole investor psychology thing, it can really make some waves.
Totally. And speaking of navigating those choppy market waters, Disney's been having their own share of ups and downs lately.
Yeah, it seems like not even Mickey Mouse is safe.
Not even the mouse. But here's an interesting twist. Seaport Research Partners, they actually just decided to upgrade Disney stock.
Oh, really? What made them so optimistic? Give me the good news.
Well, they're banking on a strong economy, hoping that'll lead to more people heading to the parks and also fuel the growth of Disney. Plus, they really like Disney's decision to, jump on that paid password sharing bandwagon.
Which seems pretty smart, right?
Seems like a no-brainer. But even with all of that, investors still seem a bit hesitant. They're not fully convinced yet. They want to see some actual results from these new strategies before they go all in.
It's a good lesson for any investor. Don't just blindly follow the hype or the headlines. Do your research, look for those concrete signs of improvement, make your own decisions.
100%. And to kind of wrap up our little world tour of the market and all its surprises, we've got to talk about this interesting development in the world of packaged food. So PepsiCo is in talks to buy CD Foods.
CD Foods. Okay, that name sounds familiar. Why do I know that name?
They make those grain-free tortilla chips that have been getting super popular.
Oh, right. Okay. Yeah, I've seen those at the store. All right. So how much is PepsiCo willing to shell out for some tortilla chips?
Get this. They're reportedly ready to drop over $1 billion.
$1 billion for tortilla chips.
That's a lot of chips.
That's a lot of chips. What's the strategy there?
So it really speaks to a bigger trend in the packaged food world. Consumers are getting more price conscious these days, and these bigger companies, they're looking for ways to grow, expand their reach, bring in new customers, and acquisitions. That's one way to do it.
It's all about staying ahead of the curve.
Exactly.
Wow. So we covered a lot today, from consumer spending to those surprise winners that no one saw coming to, like the market's totally unpredictable reactions to, like, even good news.
Yeah, it's been quite the ride.
So as we wrap up this deep dive, what's, like, the one key takeaway for our listeners? What's the thing they should really, like, hold on to as they're navigating these crazy market waters?
I think the most important thing is to think for yourself. Don't just follow the herd. Don't make assumptions based on like a quick headline or whatever. Dig a little deeper. Understand what's really going on, how these different trends might affect your own decisions. The market's always changing, so staying informed is key.
Words of wisdom. Well, that's all the time we have for today's deep dive. We hope you found it insightful. And as always, happy investing.